afternoon, good evening, depending on where in the world you're signing in from. So at least 5 time zones today, so great to have you guys with us. Appreciate you making the time. Today we are talking about M&A in the mining space. I know you guys asked for it, and I am eager to have the conversation. And I'm lucky enough to be joined today by Michael Kaswan, the director at TDG Gold, Brian Boss, CEO of Kupani, Mark Jarvis, CEO of Giga Metals, and my very own patron, Daniel Barrington, CEO of Six Inc. And here's how today's going to work. I'm going to prompt a number of questions. You're not here to hear from me, so I will simply be doing the prompting. Then I'm going to kick off the conversation with the panel today. But then we're going to get into some audience questions. So this is an interactive event. There's a chat button on the bottom right of your screen. Please do take advantage of it at any time during today's event. Now, one thing, we're going to try to stick to the topic. If you have questions about individual securities, still ask them. I'm going to send them through to the respective teams as this event ends. But if it's on topic, I'll try and work it into the conversation as well as possible, or we'll jump to it near the end. One last piece of housekeeping. Today's event is being recorded and will be available on both Six.com and also our YouTube page, likely by the end of the day, Eastern time. But that's enough out of me. Let's get into the protein of today's events. Brian, I'm actually going to go ahead and start with you with the big question that kind of starts off here. How has the current environment affected M&A activity in the junior mining sector, and particularly for critical minerals and precious metals?
Well, I guess let's define what we mean by the current environment. I mean, $3,400 gold, that's a huge plus. The copper run recently is good. I'm sure we'll get the nickel later, but it's a better metals market than we've seen in a very long time. And you know what you see in the metals market 1 year is 3 years later in the cash flow of the businesses. So I guess the first important thing to say is that the junior deals, down in the market caps we're talking about here on this call, they never get mentioned in the public even when they do happen, right? Anything with Newmont in the story or Agnico in the story is all over, the provincial news or the city news. These ones largely go unnoticed. And I guess my second important point is that we're still very, very early in an M&A or mergers and acquisitions cycle, and I guess that's also because we're early in the metals cycle. To say it another way, or to identify, kind of who the buyers are right now, the buyers are looking for cash flow in the immediate term, right? But they want to do deals that they can say to their shareholders, "Yeah, we bought this. Here's the cash we're going to get from it. It starts next week." I'm being facetious, and there'll be enough free cash that we can pay dividends, because everyone knows that that's what people want right now. And I'll contrast that with where I think we'll be in 6 or 7 years, where the M&A deals will be about growth, right? People will be buying exploration companies in order to own that exploration success. And that's not really where we are today. So I guess that's it. We're early. We're going to get later as we go further through it. And I guess a reinforcing point for what I just said is that the M&A money, the deals are getting done, the buyers who are in those deals are from inside the industry, right? It's people that already have mines and they're maybe facing an end of mine, or they've made enough profit in a couple of years on their current operations that they can now have some cash to do a deal, which just wasn't the case in most of the last 10 years. So now deals are possible, but it's important to note that the money is coming from inside the industry, not outside. So there's no one taking a private equity approach or a venture capital approach or let's own this and see what it turns into in the next 3 years approach. That is not what's on anyone's mind unless it's already attached to cash flow. So look, I could go on for another 3 or 4 minutes. I would talk about, there's a deal that got announced just yesterday. Interestingly, it's a company that has about 3.5 cents of cash per share. And it did a deal at 2.5 cents in order to get control of a copper nickel project in Quebec. So that just tells you that, deals are getting done when they are getting done. They're not sexy valuations. They're not outrageous valuations. Things are cheap. We're early in the cycle. And I don't want to talk too much, so I'll stop.
No, appreciate that. Michael, I'll throw it to you for what are you seeing in the market right now?
Yeah, the short answer to me is with confusion. That's the short answer. That's as succinct as I can make it. But to back that up, I mean, let's look at Newmont, for instance, who just reported quarterly earnings here. They've got $1.2 billion in free cash flow. They've sold 6 mines, 6 assets over the last 6 months. So you're seeing these divestitures from these mega mergers, which has happened before. Also, just recently this week, of course, was Barrick selling their interest in Donlin Creek. So you're getting these big asset type sales that are, hitting you like waves, I would say, in going and thinking of what's happening here. In the Southern Hemisphere, you've got the South African companies that are actually been pretty aggressive. They've been acquiring projects and assets fairly readily. So there's a real strategy as far as how these different companies are threading the needle respectively. And there's a variety of reasons why, and we're going to get into that in this call, I'm sure. But to the casual observer, I'm sure that they don't know whether this is a bear market or a bull market. But I concur with the idea that we're early. And it's because of the fact that you're seeing these stutter starts. You're seeing more interest within the sector than without. And you're seeing a bit of reorganization within a lot of these different companies as far as how they're going to build themselves properly and try to build their asset base, in a real positive way, and trying to figure on getting to that tier 1 status, which of course is critical to all of these companies. But meanwhile, they don't want to miss, the commodity trend. Strong commodity prices mean that you have to be in production. And, I'm not picking on Newmont, but their quarterlies are very fresh. Their production dropped 10%. So, why the reasoning behind the sales and what exactly is their objective in all this? So I'll just leave it there.
I like with confusion. I think that's fair. Mark, I'm going to get you in here if you don't mind. For a young man, you have seen a lot of markets. I'm curious what your perspective is on the current one where we're at for M&A.
Yeah, thanks, Romy. I guess I'm feeling like the elder statesman here, and I'm sure we've all seen these cycles before. I agree. We're extremely early. Valuations are very low. It still looks like a bear market in most things, unless you're happily in gold, which our company is not. We're in nickel. But just in general, the way these cycles go is, Brian's right. They go for cash flow first. They go for near-term cash flow first. And why wouldn't they? It's affordable. But later, as the cycle goes, and if gold continues to charge ahead and even just maintain the levels that it's at for a few years, and if copper continues to perform well and so forth, the big companies end up with so much cash flow and so much cash on their balance sheet that it gets to the point that their investors insist that they deploy the capital for growth. And that's when they start looking for the exploration plays, is later in the cycle. And then, as happens every time, it'll become a frenzy. I'm looking forward to that stage. That's still, it's still a few years away, but we will see a frenzy. And the big companies will, once again, overpay for assets. And then when the market turns around, those CEOs will get fired. CEOs that are more careful with the capital will get hired, and they'll stay in place through the downturn. So they're not the ones that'll go, get aggressive. And it's my, something else I would add is that in Canada, in particular, projects are for sale. Like, they're on sale. They're cheap, and it's because the junior mining market has been so bad. In Australia, the junior mining market is more robust. I'm not saying it's great, but it's certainly more robust than it is in Canada. And there's reasons for that, but that we probably shouldn't get into right here. But as a result, I'm seeing a lot of Australians, both juniors and larger companies, are shopping in Canada because they recognize this is where the bargains are. When you've got a robust junior sector, the projects themselves are not cheap. The projects in Australia are not cheap. But in Canada, they are.
No, that's an interesting perspective for sure. Daniel, I'll get you in here. I know you got some toes in tech stocks as well. I'm curious what you think about where we're going in M&A for mining right now.
Definitely. I agree completely with the sentiment that the market is confused. We're seeing people moving in both directions. I think that's where the alpha fundamentally lives. The way I look at this market is just looking at what we know to be true for sure. What we know for sure is that major mining companies are running out of reserves and they're becoming less and less productive over time. What we also know is that there is a strategic rebalancing geopolitically, where there are two spheres of influence emerging in the East and in the West, and that's going to have significant impacts on supply chains. And so in terms of this M&A market, we're seeing the beginnings of more activity where M&A transactions are up about 30%. We're nowhere near that frenzy that Mark's referencing. And so the view that I have is very much get positioned, because once that frenzy takes off, and in the gold price environment that we have currently, and the battery metals environment that we're also seeing, it's going to be very, very aggressive. And so my view is that we're in the perfect storm for investors on the hunt.
Nope, certainly appreciate that. I know we've already talked a bit about which commodities are ripping right now. Obviously, you'd have to be a bit blind to miss gold's ascent in the last little while. But I know, Brian, what you said right off the top was you think gold's obviously hitting now, and then copper, and then nickel farther down the line. What do you mean by that? Over the next 2-3 years, where do you think those chips will fall?
Oh, I think gold's going to stay where it is or higher, no doubt about that. And as Mark said, the gold doesn't have to keep moving higher for the M&A frenzy to just get thicker and thicker as we go, because the cash flow being created at these prices is just going to build upon itself at the company's level. Look, you can't get off the internal combustion engine without copper. Yes, you need all kinds of other things. You need graphite, you need rare earths, you need a laundry list, the tungstens and things, but the final boss of electrification is copper. And, that's going to continue. It may not continue at the pace every government expected it to continue at 5 years ago, when it was easy to put a mandate to ban the combustion engine and have everybody electronic in 15 years. But if not 15 years, it'll be 25, right? The economics are just pretty clear. It's the electricity is way cheaper than oil. There's no oil changes. The car has fewer moving parts. It's just, that's the way the future is going to go. So gold continues. Copper will catch up to gold at whatever that pace looks like. Gold will drag platinum and palladium with it, and eventually the nickel situation, which everyone right now will say Indonesia is creating so much nickel. At some point, that'll be discounted in the nickel price, and I'll leave others to talk about when that is.
I'll actually throw it straight to Mark. I know you've got feelings about Indonesian produced nickel. So I'll throw it straight to you.
Nickel's going to go up one of two ways: slowly or quickly. And the scenario for slowly is nothing changes. Gradually, in Indonesia, they've come from nowhere to, I think there's something like 55% of world production of nickel, backed by a lot of cheap Chinese capital. But it's like every other mining camp in the world. You take the best stuff first. You take the highest grade. You take the stuff that's logistically the easiest first. And they're producing so much nickel that the really good stuff is going fast. And so gradually the grades are dropping and the logistics are becoming more difficult as they move farther from the ocean. So that's the slow scenario. And in the meantime, nickel is, the best metal for energy density in the cathode. It's just physics. You can't do better than nickel, at least not affordably. And so the demand continues to grow. So what's the fast way nickel could go? Well, the fast way would be is if the Indonesian government decides to restrict the mining licenses and do some supply side discipline, as they call it, as the Saudis do in oil, to not go at full speed, to throttle back a little. And if they were to announce, that they're going to restrict the mining licenses, one of the figures I've heard is by like 30%, nickel would leap up in about a week, I think. So, but will that happen or won't it? I don't know. I just don't know. So it's a possibility.
Nope. Appreciate that. Daniel, I'll throw it to you for your view on the future of which commodities are going to go in which order for M&A.
Absolutely. I think gold, by and large, has been leading the pack, along with copper. And so that's very much where I've been looking, largely. I see right now that copper supply deficits are 8 to 10 million tons annually by 2030. And so I think very basic, just looking at the fundamentals, you can predict what's going to happen.
Nope, appreciate that. Michael, any last words on this topic before I get into some fear from the chat? So we'll handle that in a second.
Well, the price action of gold, coupled with the fact of the quarterly numbers that are coming in, great, showing these great cash flows, and what are the seniors going to do with it, and all of the speculation therein. You want to really start speculating on the macro sense. We can talk about things like, how much gold is there in Fort Knox, and who does it belong to, really? And Canada doesn't have a gold reserve, and what's the wisdom behind that? Maybe they should develop one, and other countries are thinking of it too. So U.S. dollars, losing their reserve status, people dumping bonds, all of these types of items, I think, are on people's minds in a macroeconomic sense. So I think gold is the shiny metal right now for sure. So I definitely back that idea up, and we'll continue to see a lot of capital. But there's also a very expedient factor involved, in meaning that, typically the larger companies are, of course, looking to replace what they describe as tier one reserves, so the best of the best. But that luxury requires typically time. And given the commodity kind of cycle and the acceleration that we may be in, they may not have that luxury. So what that means is that expedient projects that are permitted in the right locales, that have the right kind of infrastructure already surrounding the permissions, both social and governmental, those might be the ones that really fit the cycle, even though they are not considered, the crown jewel per se. So I think that's also on companies' minds. Having said that, I think copper is also undervalued. I agree with the concept that Canadian assets in general are undervalued across the resource, horizon. And gold is just starting to get attention, but there's a very nifty way to start looking at copper gold type exposure in a variety of companies that are out there that are aggressive and forward thinking enough.
Well, thank you. I'm going to go into some scared folks in the chat talking about the downside, the scary parts of M&A. Openwheel says, with the enormous cash flow going to majors, I'm more worried about junior companies getting taken out too early. So in this environment, should CEOs not try to flush as much value as possible before suitors come to the door? And Wesley puts it very succinctly, how do you avoid getting scooped by an Australian? Michael, I'll start right back with you if you don't mind.
Yeah, we're all terrified of being scooped by the Australians. We'll have to start drinking their beer or something like that to get along with them. But I think the idea of, in a sense, what we've done is we've really looked at getting a strategic partner that is, can help us with regards to not only technical input, but also obviously the financial aspect of things, and really appreciating where we're trying to move towards. Because otherwise, CEOs of these small companies are always fighting the idea of what kind of financings are they able to put in place that makes a lot of logical sense for them, that their shareholders can live with. But I totally agree with you. I think it's a matter that, we as CEOs have to start demanding more, respecting ourselves more, even though the last 5 years has been fairly vile to us. So I think that, if there's a call to arms on this call and on this panel, that to my mind would be it. And I think the idea of working as best you can as far as getting the structures involved, putting your money where your mouth is, these types of somewhat throwaway sayings continue to be very important. But yeah, it's always on my mind every day is not to give not to give the farm away here too quickly, because I think there's a lot of build. And I think time, in a sense, is on our side now, finally, that we're starting to see these commodities start to really move.
Well, thank you, Michael. And Mark, I'll throw it to you because I know you said everybody's on sale. So how do you avoid getting sold too cheap?
Yeah, I was wanting to jump in anyways because, I think really all you can do is be out there telling your story. And, and so that if that time comes where someone makes a run at you, then there's enough people that know the story and perhaps enough other companies that have done a due diligence that it might turn into an actual bidding war. And so, you set that up, you set the possibility of that up by just being tireless and just being out there and telling your story. It's as simple as that.
I appreciate it. Daniel, I'll throw it to you. I know I've seen a lot of sales now in the industry. I know that sometimes investors get kind of asked, even when there's a good premium. What do you look for as an investor? What are you afraid of when it comes to M&A?
Largely, I'd say too low valuations. And I think that often happens when companies are exhausted, where they've been put down by the market for so long that they're looking for any possible exit that they can. And the only real antidote to that is, to Mark's point, telling your story, being out there, being at the conferences, being on the webinars, speaking with people, and making it so that investors are ready and aware of the project that you have so that they stand by it and support it.
Well, good answer. Brian, I know Kupani's in kind of an interesting position here, but I will ask you, just as was phrased in the chat, how do you avoid getting scooped by an Australian?
We have a magic bullet. Insiders own 52% of the company. I own 32% of the company. No one is stealing this from us. We are building someday for an auction, the bidding war that Mark talked about. We're doing it by telling the story constantly that Michael's talking about. But if you want to not have the company stolen from under you, own it. So that if someone comes up with a bid and it's hostile and it undervalues your company, you can tell them to go pound sand. And that's what we're going to do if that happens to us.
I wanted to close you on that one because I knew you had a fun answer for it. Now, I do want to zoom out and talk about geopolitics for a second, because I do think it does impact the M&A space. With tensions worldwide, I think nobody could argue they aren't rising. And critical mineral strategies by major economies starting to influence, I think, acquisition interest. But I'd love to talk about it commodity by commodity. So, Michael, I'll start with you. How do you think the geopolitical scene is impacting not only the price of gold, but the likelihood of companies being scooped for gold?
Oh, well, the macro sense, I mean, some of the things I already touched on, certainly, there's a fire underneath gold for a variety of reasons here that we're looking to continue. But I think also, the idea and the interest behind now gold and gold production really starting to be at the forefront of people's imaginations now that it's starting to make money. I mean, this is part of the problem of our sector. The investment that's been put into gold and gold-related assets is so minuscule. It's ridiculous. You've got a very, very small amount of money that's put into this space already. So everybody's sort of battling for significance at this point in time with regards to that. But higher cash flow numbers is going to get the attention of the bigger fund managers. Newmont's performance, it being the only gold company in the S&P 500, and starting to see real appreciation in that sense as well, I think it's going to be also likewise important. And eventually that's going to lead to better discoveries. And what's really driven the juniors in particular is this sort of discovery cycle. But we've got a little bit of chewing that needs to go on for the time being. And that chewing involves, these mergers and these reorganizations that we're all talking about here today. And also where you're going to get investments from aligned partners. So not only do you need internal ownership, as was already discussed, but having aligned either funds or corporations that again can see where you're trying to develop this opportunity and build it accordingly. You're on mute, Romeo.
Awesome, my bad. Brian, I'll throw it to you next. I do want to talk about copper. So obviously with potential for tariffs across North America, we don't know where they're going to set out, with China continuing to build. Where do you think the copper space goes next? And how do you think it'll impact acquisitions across the field?
Well, I guess I'll open by saying Daniel was right. Daniel's opening comment was that I'm paraphrasing, the world is kind of breaking into two economic blocks. One is China-led and the other is US-led. And I'll add to that to say that there will be higher tariffs for trading between the two blocks than there will be tariffs within the block. So now zoom out for a second. Anybody in North America or in Europe, maybe Australia, too Chinese related. Anybody in North America or Europe who is buying copper for a project is going to have to buy it from someone who's not in China. And if they are going to buy it from China, they're going to pay an import tariff that raises the price in a way that supports domestic production. So I'm not sure that's answering the question, but that's where we're going to be. And then Canada and Quebec, where we are, is going to be, the belle of the ball, because if the buyer cares about low carbon intensity, well, Quebec is exactly that in its power. If the buyer's in Europe and cares about how many days of marine bunker fuel get burned to ship it from China, well, there's an Atlantic port on the St. Lawrence River that our material will go to. So, it's 3 weeks closer to Europe than it is for it to source from China. And then finally, I'd say this reorganizationing of the geopolitics that Daniel's talking about, I think that it means no matter who wins the federal election in Canada next week, I think we've just seen peak permitting delays, right? Whatever's going to happen, it'll get better from here. Because if we can't sell to the U.S., we have to sell products the rest of the world wants. And that's the resources.
Makes sense. Mark, I'll throw it to you with obviously nickel project in BC, so in Canada. How do you think geopolitical scene will impact kind of the future of the nickel game in Canada?
That's really hard to say. It's all about, once again, price right now. When the price is this low, it's difficult to advance a project. So it definitely does slow things down. And that's why we're kind of pivoting to exploration with our company. We've got an asset. We know what it is. If you improve the nickel price even slightly, suddenly we've got good economics. But we've also got, copper exploration targets within the same mineralized system. We've explored maybe 20% of this whole ultramafic complex. And, I think I was quite excited to bring in Dr. Beresford to look at all of our data and suggest to us, what targets we still have. And he's come up with something that in an area that I had written off, he thinks we've got a Volkovsky-style copper target. So, that's really interesting. Nickel in general, there's a few nickel projects in Canada. There's not much in the United States. If you want a supply chain for the battery business in the United States, you're going to have to develop these projects sooner or later, or you're just going to have to give up and rely on China. And with the current, tariff environment and political confusion, I don't think it matters that much because, it takes, 5 years at best? If you've got the money today, it takes 5 years to build and start producing a major mine. So this will all be behind us by then. And, we can build a battery supply chain in Canada that Europe would happily buy because,
Sure.
We've got high environmental standards in Canada. Everything that makes the Europeans feel good is something that we do here. They won't necessarily pay more, but they will preferentially buy.
No, I think that's an interesting perspective. And Daniel, as an investor, how have the last, we'll come 3 months of capital P politics, have they impacted what you think about jurisdictions or which ones you look for?
Yeah, certainly they have. I think that's what we're seeing right now in the market, and what I expect, as Brian mentioned, we'll continue to see, is that the universe of projects that can actually become a mine has become much, much smaller. And so from an M&A perspective, what that means is that as a project, you're no longer competing against every other project in the same asset class. You're now competing against a narrower set. And within that narrower set, what that means is that you're going to have, as a target, there are fewer options for potential acquirers to choose. And especially those projects that are closest to development or that meet their criteria the most, those are going to become very, very obvious. And I think that's significantly different than what we've seen in previous markets, where jurisdiction, although it mattered, hasn't nearly mattered as much as it does now, or as much as we expect it to matter in the future. And so that becomes much more of a weighing factor.
No, appreciate that. There's one question from the audience that I think is really interesting, so I'm going to tackle it now. Raziel says, all this conversation about tariffs and strategic minerals has prompted governments to advocate speedier permitting for mining in general, which I think we are seeing, even places like Mexico, et cetera. So what specific advice would you give to governments in that regard? Should we educate regulators about mining? My question is, how would you do that? I'll throw it to the whole audience, the whole crowd here. Anybody who's got an answer, please feel free to go for it.
I'll jump in to that one. I think that you need to throw resources at it. and particularly in Canada, where there's another level of government involved now, and that's the First Nations. So the First Nations are definitely players in the permitting process, and we can't be blind to that. So what does that mean? Well, it means that if they don't have the capacity to process permit applications, that's the weak spot. That's where it slows down. So who is going to provide the capacity to the First Nations? Some First Nations have got pretty good capacity. Some have terrible capacity for processing this sort of thing. And I would suggest that that's the job of government, is to step in and provide the capacity so that First Nations, in conjunction with the provincial and federal governments, can evaluate a project in a meaningful way.
I like that perspective. Anybody else want to talk about how we can educate our politicians? I know people usually like to do that. Go for it, Brian.
I'm actually not going to say it's the politicians that need educating, although I often say that in my life. But I'll note for the crowd here that on the 26th of March of this year, the Supreme Court of Canada ruled on a dispute between TDG Gold and the Canada Revenue Agency. Right, Mark knows where I'm going with this. Okay, so CRA for many, many, many years had said that flow-through spending or development expense spending, exploration spending, that they defined what that was, even though the legislation said it's money in furtherance of discovering the location, the amount, and importantly, the quality of a deposit. Okay, CRA, trying to collect as much tax as it can, has for decades taken the approach that quality does not include anything to do with the economics, right? So your feasibility study, your retesting something after you take over the project from a prior company to prove that it is what they said it was. That's probably a bad example. Environmental studies, guys jump in here with others. CRA was saying for years that those are not acceptable spending, not acceptable expenses for exploration or development. And hats off to Seabridge, who took the fight the whole way. They won at the Supreme Court, and this now opens the doors. We can talk about why it's hard to get money in the first place, but now once you have the money, a company like mine can say, well, we can keep using that kind of expenditure all the way from exploration out to the level at which we're going to get bought out by somebody, because we've done all the reports in the 43-101s, and we can use the tax credit system for that spending to do those reports. Whereas if CRA had their way, you'd have to use what are called hard dollars, right? Like more expensive money. It comes down to the cost of capital. And if anybody wants to jump in on this, I know Mark.
The one thing I'd jump in, because I have some experience with it.
Yeah.
We had a dispute with CRA back in the 2010s, where they audited us and disallowed a bunch of CEE expenses. And it turned out that their public definition of what qualified as CEE, their published on their website definition, was not their internal definition, and in particular, metallurgy.
Yeah.
So they nailed us and said, well, you can't use metallurgy as CEE. And I'm going, well, how in heaven's sake are you going to figure out the quality of a deposit without metallurgy? You can have the greatest grades in the world, but if you can't recover any, it's very low quality. You can have lesser grades, but you've got really high recoveries. It's the net recovery that counts at the end of the day.
Yeah, just to jump in, Mark, on that. I mean, I think this education within their own bureaucracies and sort of understanding our business. But I'd also say, the timeliness and how that affects these companies is also key and critical. They've got to get it, and they've got to get it quickly. But my only main point is looking at how you're getting, let's say, regulators from the top, let's say the federal level that are now in provincial levels that are now motivated to get things going, given the big threat that the United States represents, or developing other markets, or all of these other types of ideas, as well as making sure that you've secured the local level of social permissions as well. And that's typically First Nations in British Columbia. So I think that that's, getting a blend and a meeting point, if you will, between those two major entities as far as clearing the bureaucratic cycle for a junior exploration company is key. In addition to what Mark is highlighting here, which is these companies understanding their own definitions to an extent.
Sure. Daniel, got any last notes on this before I jump into mid-tiers?
Yeah, to add in there, I think one of the really interesting ways to educate regulators in particular is framing the conversation a bit differently. Right now, I think for a very long time, certainly a duration of my lifetime, we've seen significant extraction from Canada to pretty much everywhere else in the world for pennies on the dollar. We see this in the form of brain drain from Canada to the United States. We now see this even in the difference between the US dollar against the Canadian dollar. And what that means, if we don't have more support for Canadian mining domestically, is that countries, whether in Australia or in the United States, friendly countries, are going to be able to buy quality assets and benefit from the ownership of it. And the only real way to counteract that is to allow that value to be built domestically here in Canada. And the way to do that specifically is through better regulations on the CRA side, like what Brian and Mark and Michael have discussed, as well as through other mechanisms to actually allow permitting to advance more rapidly. And so I think framing the discussion as a Canada first discussion to regulators is something that will actually lead to policy changes. And I think that's why we're already seeing these policy changes coming to fruition in an environment where for the last 20 years, the resource sector has been hated.
Thank you, Dan. Thanks, Rachel, for a great question. I do want to talk about mid-tier producers, because I know we've talked a lot about Newmont and the big boys, but I do want to talk about mid-tier. And Michael, I'm going to throw it to you first. At what point during the current M&A landscape do mid-tiers start to do gobbling? So they start to deplete resources. And how does that affect juniors' strategic positioning?
Well, I think what's on the mid-tiers' mind, everybody wants to get bigger in this business because scale is king. So I think it's a real opportunity, given the asset prices and the expansion that they can see within. But they're battling with the idea that they themselves view that they're undervalued as well. And that's telltale of where we are in the cycle. So you're seeing things like cash takeovers where they can be done, or you're seeing these mergers of equals, which means both sides both have come to the agreement that we're both undervalued and we're better together. So I think that that's a real opportunity to grow. And if you look at the history of some of the, let's say, the senior mid-tiers that are around, or even senior companies that exist, that's the genesis of how they've come about, exactly through markets like this. So not only is the opportunity there for investors and people who have the foresight with regards to what happens over the next 3 to 5 years, but also with respect to these companies building themselves and really looking at how they can grow their platform out, access a variety of different properties and projects that in turn make sense for them. So I think it's a really interesting mix, especially if there continues to be lack of respect from the outside of the sector itself. Then I think you're going to see that be recognized within the intermediates themselves, and they can go through a real aggressive growth spurt. Because if you think about it, they can't outspend the seniors, they know that. So their leverage is really how nimble and how quick they can be with regards to beating everybody else to the punch. And I think assertive, aggressive intermediates have a great opportunity in front of them, given what's happening, especially if they've got cash flow themselves, which a lot of them do, and it's starting to improve pretty significantly. Because just of course, the economics way of thinking about it is their, let's call it, lower grade or lower tier type deposits actually have better leverage as the gold prices start to move northward, as we've seen now.
Great, thank you. And Brian, I'll throw it to you for what do you see with the mid tiers up to?
I guess I'll say two things, and I'll be quick because I don't know that I can add much to this answer that Michael's given. I agree with him that mid-tiers, if run well, become seniors. I would point to Agnico. I've been an Agnico shareholder for over 20 years. And as a management team, they've done all the right things. As a matter of fact, I try to steal from the greats. So when we named our company, we ripped off the Agnico name, which comes from the periodic table of elements. And then the only other thing I would say about mid-tiers versus seniors is, if it's a couple of years from now and our company gets a bid from somebody, our shareholders, including me, would be looking for a transaction that doesn't give us cash, because then you have to pay tax. We would look for a tax-free rollover of equity into the other equity, and that resulting entity, I would hope, is a decently valued company that has great growth prospects after we're added in, but still pays a dividend, so that people can hold on to their original shares they buy today and end up with the next Agnico. That's kind of where I hope it goes.
Cool. I like that perspective. Daniel, I'll throw it to you for a quick word here on what do you think mid-tiers are up to?
Certainly. I think generally speaking, what I expect from mid-tiers is firstly that they're going to be making acquisitions that are regionally where they're operating. They're looking really nearby. And I think that already limits the number of potential buyers when looking at who is likely to acquire an exploration stage or a development stage, a company in that earlier Lassonde cycle. The other aspect is I'm expecting large mixes with equity being involved in the transaction, where unlike larger tier companies, I expect the financing to be a mix of those shares as well as cash.
Thank you, Dan. Mark, any words on the mid-tiers?
Yeah, I've only got really one thing to add to that, because it's been a pretty fulsome response already. A lot of the mid-tiers, not all of them, are run by bankers rather than mining people, and a lot of those bankers are looking at the stage of the market cycle, and I know this from talking to several of the mid-tiers, and where they're on the cycle, and they're looking 5 years out and going, how do I position my company for it to be taken out by one of the big ones at the best possible price 5 years from now?
Sure.
And so they are focused on cash flow. They're focused on near-term cash flow. They'll do exploration plays. They'll do pipeline style plays as well, but there's less of the focus there, because basically in a takeover, you're not going to get paid much for your pipeline plays. You're going to get paid for your cash flow or your near cash flow. So that's where they are right now. And again, as we were discussing right at the beginning here, we're early in the cycle, and that's all part of that.
No, absolutely. So I'm going to get into some specifics of all your individual projects right now, if you don't mind. And Michael, I'll start with you here. What specific milestones or achievements has TDG Gold gotten up to that makes you more attractive to a future potential acquirer at a price you like?
Well, the advanced stage of our asset, our property is very, very. It's a key to the area that's developing with gold. Gold to the north, copper gold to the east, and then more copper to the south. So we're in a really great area from a logistical perspective. So if you were only to look at this from a land value perspective, you'd say this project area is key. In addition to having the right kind of advanced, mining tenures in place, existing tailings fields, infrastructure, all of those types of permissions that are necessary in order to make this move along quickly. Because I always think of time being the enemy, and not only would an intermediate or a potential producer look at it that way, it really affects the NPV that they're going to be able to project, is really by hammering down the number of years till you get to actual production. So I think that's something that we've spent a lot of time. Obviously, we spent a lot of time with First Nations and negotiating with them. So we're very, very aware of the permissions that we have with regards to operating, and then the importance of developing along that local level. So I think companies looking at us and saying that we've got those things in order, and the logistical or location of the property package alone is key. In addition, lately, as of January of this year, we've got what I believe is the hottest exploration play developing in all of Canada, right on our boundary. So what that the importance of the geology and the potential growth for the geology to make this a tier 1 style asset is very much along the fairway of mineralized corridor that we have on our ground. So I think that recognition of not only having the right kind of assets to build a proper plant in order and through this advanced status, but also with regards to being at the correct point at the, let's call it the Lassonde curve, where you're actually looking at exploration starting to really accelerate your share price and interest. So aside from my saying so, this is a hot area. We've got 3 major companies that are looking to invest, their capital in the adjoining regions to our tenement. So money talks, and that's a matter of that going into the ground in as little as a month from now.
Oh, great. Mark, I'm going to ask a very specific version of this question to you, and that's you have a JV with Mitsubishi, for those in the audience who don't know. What were they looking for in partnering with Giga, and how's that gone?
Well, they were looking for a long-term supply of nickel and cobalt, and we've got that. They were looking for a project that was technically not very risky, which ours is. It's actually kind of a unique deposit in Canada amongst the large sort of low-grade open-pittable nickel plays. Ours is by far the simplest. We're recovering pentlandite. 99% of the nickel and cobalt are contained, that's recoverable, are contained in pentlandite. So it makes everything very simple. They were also looking for good relations with First Nations. We've been working on that for a long time. And we know our way around quite well. We've got good relations. They were also attracted to the fact that our tailings will sequester CO2 directly from the atmosphere. And in fact, we've designed our tailings management facility to be what's called large beach, small pond, so that you've got the maximum surface area exposed to the atmosphere as you can. And we've been working with the University of British Columbia to actually quantify how much CO2 gets absorbed. And it's quite interesting. That really helps. We've got a path to, we think, to zero carbon for scope 1 and 2 at least. Now you start transporting the concentrate and processing it further, in other places. That's different. But scope 1 and 2, we've got a path to zero carbon, and maybe even better. That attracted them. That was really a talking point. And then also, we had some good people. I'm not going to blow my own horn, but we had Martin Bydra, ex-Sherritt. Just nobody knows the nickel business better than he does. And we had Lyle Tritton, also ex-Sherritt. And I'll put him as an engineer in the room with anybody. He's extremely smart and also extremely credible, because he's one of these people that doesn't know how to lie. So sometimes as a promoter, I wish he did, but but he doesn't. It's credibility beyond everything. And so it was that. It's they stepped in at what for them is a very early stage. We had a PEA done, and they stepped in with the money to do a pre-feasibility study.
Okay.
And just a great partner.
I think it's great. Yeah, I can certainly attest. Lyle's one of the people that intimidates me every time I talk to him. Not from his attitude. He's very nice, but he's very smart too.
Yeah.
Brian, I'll throw it to you. How has Kupani positioned itself to be at the right time and an attractive candidate for acquisition?
Yeah, so we've done a few things, but the one I'll highlight here is that we have been picking away at staking and buying and assembling this claims package for more than 10 years. And we started by staking around a historical resource that had never been mined, but had been brought to a mining lease. And we basically finished all that good staking in, I'll say, 2023. And then in 2024, myself and my business partner, Douglas McCory, went out with a couple of geos. Douglas, for those who are on the call, some of you will know he built Asante Gold from nothing to 3 operating gold mines in Ghana with a 2 billion market cap at its peak. Anyway, we came back from the first week of prospecting where really all we did was visit the historicals and some of the showings. And we found a map online that the Quebec government and the federal government published in 2015. Nobody noticed, nobody cared, nobody had done anything about it. And it was a map of copper and nickel in the lake beds at the southern Labrador Trough. And here's what we did that makes us an attractive candidate when the time is right. Douglas and I asked ourselves over breakfast, so, if we're right that, the 5 million tons in the little zone that has the historical can become 20, 30, 40, 50, 100 million tons, which was Douglas's thesis, what does it mean for the rest of the zone? Because it's all the same rock, right? It's 160 kilometers long of the same rock. And Douglas said, well, we better grab the whole fucking thing, Ben, haven't we? So that's what we did. We have over 500 square kilometers, and there's no way to do work in the South Labrador Trough except through us. And that's what we've done. When we have success, and Anglo-American used to have some of our land. It was their nickel exploration play. When they want to come back, there's no other land to get except through us. That's our move.
That's a move. I totally get it. Michael, I'm going to throw a question just to you here. I know TDG Gold already has strategic investment from some bigger players. So first, at the beginning of the question, lead off with letting people know what those are. But I'm curious how their involvement impacts other big players from getting on board, again, when the time is right. I'll throw it to you.
Well, on the corporate level, I think it gives the green light that corporations ought to look at this and be interested because you already have that corporate involvement. I believe it catalyzes that entire situation. So, as you're hearing me say, I guess I'm younger and more impatient on these things, but I want to see things happen and start to really get in motion. And I think having a corporate partner assists in getting to that end sooner than later. On the institutional side, I mean, for a small company, we have a lot of institutional players who are already involved. And these guys do good research internally. I think individual investors can feel very, very qualified in looking at this as an investment, given the homework that's already been done on the institutional level. And these guys are not just doing research reports, they're employing their capital into these issuances as well. So I think from both the institutional and, let's say, the corporate, you're getting that validation, that vindication as far as how this is going to be able to develop. The catalyzing aspect of it, I think, is important because it's a matter of let's get this show on the road, and I think the market will understand that there's always going to be this interest corporately in this additional amounts of capital that can come along and help things along. But in our particular case, not only is the intermediate not the biggest mining company in the world out there, so it's not necessarily going to scare everybody away, but also their ownership level is kept to an amount that makes that keeps the door open, let's say, for other involvement, whether that's institutional or corporate as well. So I think controlling those factors as best as you can is really the best you can do.
Great, thanks. Daniel, I got one for you. As an investor, what do you think makes a junior most appealing as an acquisition target? You think it's resource, location, team? What do you think? If you had to sum it down to one thing, I know it's a million things, what do you think the mid-tiers and majors are looking for?
Sure, I'll sum it down to one thing.
Sure.
I think it's important to remember that companies don't get sold, they get bought. And so the number one thing is, what is the strategic value of the company to the acquiring party? And so that's a mix of the asset, it's a mix of the jurisdiction, the technical de-risking, the team quality, the capital structure. But ultimately, it comes down to what level of conviction does the management team acquiring the junior have that this is going to create shareholder value and that they can either create that value in a short period of time or explain to their shareholders why it's an accretive process.
Oh, great. I appreciate that very much. Brian, I'm going to ask you a tough one to answer, so bear with me here. I imagine Kupani has had some interest from bigger players. And to the best of your ability, I know you can't be 100% candid about every offer. I know how this works. Let us know in the room just what you've heard and what that tells you about the space.
So, yeah, we've had some unsolicited conversations. We obviously didn't come to terms. The main sticking point was the other company's CEO wasn't prepared to pay what I was asking for on behalf of shareholders. Obviously, we still go to the board and everything, but and the main reason for the difference is because of each one of us had different assumptions about the exploration success still to come, and the other CEO didn't disagree that we're going to have the same amount of exploration success that I'm suggesting. He was just not certain that Mr. Market, right, his investors, his stock price, was going to reward him quick enough for doing the deal. And, you know, they've gone on to other great successes. That company is also currently the belle of the ball with something else that they already had. And we'll get there too. We'll be the belle of the ball ourselves soon. But yeah, you know what, Romeo, sometimes it's just too hard. You can't get the deal done.
Sure.
You know, like I said earlier, everyone wants cash flow, and we are as far away from cash flow as we're ever going to be. And every day we do more work and we explore more and we find more. We're getting closer to that. But, you know, it'll be, yeah, you know, every day that goes by, our prospective pool of buyers grows, but we haven't gotten close on anything yet.
Great. Now, I do want to give all of you an opportunity just to pitch your security shamelessly, but there's one question that just came in that I think is really interesting, so I want to ask it just to see if somebody's got an answer for it. Tom McCandless from the chat asks, teams make discoveries, so when you acquire a project, do you want the team as well? Does anybody have an answer for that? And your experience with sales, how much the team goes, which ones, et cetera?
Yeah, I mean, the sort of most honest answer is it depends, right? It depends on a lot of factors. So I think you will typically see some kind of a lending of the technical knowledge over to the acquiring company there, where they want to know, you know, where the keys are, you know, that unlocks all the right doors and sort of with regards to the geological perspectives that are being looked at on a go-forward basis. But if it's a big enough company, they tend to have a pretty good handle of what they're what kind of objective they're driving to themselves. So I think at best you can hope for a bit of a migration of a team or a lending of a team for a while, and some of those personalities might fit properly with the bigger entity. But you know, exploration geologists are a bit of a different breed, so they tend to like to explore and continue what they're doing. So it really depends, and it can come down to not only a corporate individuality, but a personal one as well.
Sure. I appreciate that. I'm unfortunately going to have to cut off that answer there because I do want to give everyone an opportunity to pitch. So, Mark, tell the folks in the room and watching the replay why Giga is an interesting bet.
Well, I think in any commodities play, the best time to buy is when everyone hates the commodity. And that's where nickel is right now. And so, you know, there's really nowhere to go up except up from here. We're at a price level where a lot of producers, like something like 50%, are losing money on a cash basis. So mines are closing down. This is, you know, the cure for low prices is low prices. And as I said earlier, the price of nickel will either go up slowly or it'll go up quickly. The Indonesian government has the power to make decisions that could move the market very rapidly. And again, I don't know what they're going to do, but they certainly could do that. And that would be something I would applaud.
Awesome. Thank you. Daniel, I'll give it to you to pitch whatever you'd like, but I have a guess what it might be.
Yeah, absolutely. So first of all, thank you everyone for joining and participating on our platform. We've been releasing a lot of new features. So right now, after this event is done, go to our homepage and you can actually type in the name of any of the companies presented here and you can continue the conversation. We now have chat rooms. Every event and presentation and video that's been hosted on our platform is there, as well as an Ask AI feature where you can go and get answers to some of your geological questions, and many more features coming soon. Awesome.
Thank you, Daniel. Michael, I'll throw it to you to pitch TDG with whatever level of modesty you'd like.
That's sometimes very limited, but I'll do my best. The value and speculation, which is a contradiction of terms, but the speculation part comes in the major activity that's happening around us with real dollars looking at the hottest exploration region in Canada. The value perspective is the gold that we already have. and it not being properly assessed with regards to, or I would say recognized by this market for being for having a lot of value in scoping studies, PEA type studies as well, plus the expansion that it represents. So I think there's a wonderful opportunity there to both get value and get this great upside through exploration potential that's going to be happening. We're armed with over $15 million in capital to make that happen, and in the region, we're seeing to the order of $30 million spent in and around us, and that's all happening now. So that's going to be kicking off within the next month. So you're not going to have to wait with regards to looking at things such as geophysical studies and on their way to drilling type prospects. So I think it's a really unique opportunity that exists. The sentiment in the space, as we've all discussed to some extent here, remains with us, and why you're able to buy these projects at low valuations. I won't say cheap, but I'll just say great values, especially given the upside potential that we're seeing. And that's going to come about as you start to see more of this M&A activity, which is exactly the topic of this panel. And that's going to become clear and obvious as the seniors continue to make more money, they right their ships, and then it's going to be about growth. And how do we maintain production now that we're making so much money per ounce?
Great, thanks. And Brian, close us off with a pitch for Kupani.
How long have I got?
you can roll with it.
Okay. I've made money for investors on everything I've done prior. Douglas McQuarrie made money for investors on everything he did prior. Between the insiders, as I've already said, we have over half the company. Stock is, the ticker on the CSE is Charlie Uniform Papa Alpha, CUPA. We have a USA listing coming very soon. We were in the field last year. We were in the field 3 months ago. We're going back in the field in a couple more months when the season's warm enough, the bugs are back. And what do we have? We have a 20 million market cap with 500 square kilometers of exploration land, which is a lot. A lot of that land is prospective. There's a historical resource on it. And our thesis is that the historical resource can grow by many multiples. And at, it's 5 million tons today. No reason it can't be 20, 30, 40, much larger maybe. That resource exists on one tiny little spot of our 500 square kilometers. And no one has looked at this land, in some cases ever. In other cases, no one has looked at this land since 1987 when a company came by looking for platinum. They're the ones who drilled off the 5 million tons. So we're 18 cents, and I hope we're going to $1.80 based on exploration results in the next year and a half. So I'm looking for shareholders that want to come for the ride of a 2-year duration, 3-year duration. Maybe it's a year and a half. I don't know. But the management team's in for that ride, and we're looking for shareholders who think the same way.
Awesome. Brian, Michael, Daniel, Mark, thank you so much. Thanks, everybody in the audience. Really appreciate your time and asking questions. I hope all of you have a wonderful rest of your day.